Are you struggling to pass the CPA exam? Did your review course fail to fit your learning style? I'm Darius Clark of I-75 CPA Review, the #1 course supplement, where the right teacher makes all the difference. I can't think of too many more important topics in audit than going concern. In a situation in which the auditor has substantial doubt about an entity's ability to continue as a going concern, the auditor is responsible for considering the possible effects on the financial statements and evaluating the adequacy of related disclosures in the client's financial statements. Basically, that means if there's trouble signs pointing to going concern issues, the client may already have disclosed it properly. That's the best case scenario. So, disclosures might include conditions that give rise to the assessment of substantial doubt. The client may have already disclosed the fact that they're in default from a loan agreement. They've been cut off from trade credit by suppliers. And here are our plans to mitigate the going concern issues. That would be the best case scenario for the auditor if all that is already disclosed in the client's financial statements, because then the auditor might still be able to give an unmodified opinion. So in this video, we're going to see what's the auditor's responsibility when there is substantial doubt about the entity's ability to continue as a going concern. Are there specific audit procedures performed with the purpose of detecting going concern problems? What does the audit report look like when there are going concern issues? When does the auditor have to add a going concern section to the auditor's report? To begin with, there are no separate procedures performed to identify going concern issues because routine audit procedures are considered sufficient. But when conditions or events are identified that raise substantial doubt, that's when the auditor performs additional audit procedures, including what we said, evaluating the adequacy of going concern disclosures and any mitigating factors that might help alleviate the concerns. Now, in doing our routine audit procedures, what are some of the things that will point to a going concern issue? And there's long been this acronym ADMITS. ADMITS stands for Analytical Procedures. One of the procedures that will point to a going concern issue, if we do our analytical procedures and we find negative trends or adverse financial ratios, such as a negative current ratio or a negative quick ratio, that would point to going concern issues. Another A would also stand for attorney's letters, for pending litigation, because letters from attorneys might indicate so much litigation that any one of these cases could knock the client right out of business if they lost the case. And if the auditor feels that way, then that would be something that points to a going concern issue, and then we would want to know if that's properly disclosed as a going concern problem in the client's financial statements already. Now, the D in the word admits here stands for debt compliance, and this is probably the exam's favorite. Let's say a company has a $4 million loan from a bank, and although they're current with the payments, they'll tell you, the loan contains an agreement that the entity must maintain a current ratio of 2-to-1 at all times. Otherwise, if they dip below 2-to-1, the $4 million loan can be called immediately, even if the payments are current. Well, then the auditor would want to make sure that the company has not violated the debt covenant, because that would immediately put them in a going concern crisis, especially if they didn't have the $4 million to come up with to satisfy the loan. So notice these aren't special procedures done for going concern purposes. These are audit procedures that we would do anyway, making sure that the client is in compliance with debt covenants, because if they weren't, it would point to a going concern issue. We would also read the minutes of the board of directors meetings, and that would also indicate any going concern problems. Anything of that magnitude that could knock the company out of business, you would expect the board would be talking about it at the meeting. And then the I stands for inquiries of management regarding whether they evaluated going concern. So we're going to inquire because management has their own responsibility to evaluate going concern. Then the T, talk to third parties who could be offering financial support. So the client might have some going concern problems. Maybe they've had them before too. And there's these third parties who they always go to. So if there are third parties out there who are offering the client financial support, especially if they've offered it before, you would want to go to those third parties and get written evidence that they still intend and have the ability to provide that financial support. And then subsequent events. Now, we always have our subsequent events responsibilities. One of the things we're looking for here is uninsured disasters. So if there was a fire, a flood, and it was uninsured and the client lost a lot of money, that might indicate a going concern problem. So admits would be pretty good to remember with regard to procedures that point to a going concern issue. How about this? Conditions that may adversely affect a company's ability to meet its current obligations include what? 1. Negative financial trends and recurring operating losses. Sure, we said we're looking for those negative trends, and if we find them, that points to a going concern issue, and that would directly result in a company's inability to meet its current obligations. So 1 looks good. 2, negative cash flows from investing and financing activities. Well, let's think about that. That's talking about the cash flow statement. And if there's negative cash flows from operating activities, I could see where cash flows from operating activities would directly impact the company's ability to meet its current obligations. If they had a negative cash flows from operating activities, that would adversely affect their ability to meet current obligations. But what about the negative cash flow from investing and financing activities? That doesn't really have any impact on a company's ability to meet current obligations, because if a company's doing well, they'll probably have negative cash flows from investing and financing activities, because either they're paying off debt, or they're buying new stores, or they're buying PP&E. So Roman numeral 2 does not point to an adverse effect on a company's ability to meet current obligations. But if it would have said negative cash flows from operating activities, now that would have got my attention, and that would get the auditor's attention, because now if a company's not making money in their operations, if they can't generate cash flow from operations, that would adversely affect their ability to meet current obligations. All right, which of the following audit procedures regarding long-term debt would likely assist an auditor in identifying conditions and events that may indicate that there could be substantial doubt about an entity's ability to continue as a going concern? So this is what the exam will do. They'll say what procedures that the auditor is already performing will point to a going concern issue. A says review compliance with debt agreements. Absolutely. We said if the company is supposed to maintain a 2-to-1 ratio for the current ratio and they don't maintain it, if that's the debt covenant and they violate it, then they could call the whole loan due and payable immediately. And if the company doesn't have the money to repay the loan now, they could be out of business. So letter A, that points directly to a going concern problem. B, reconcile interest expense with debt outstanding. So both of these procedures have something to do with long-term debt, but letter B really doesn't point directly to a going concern issue. While the auditor would reconcile the interest expense with the debt outstanding to ensure that the interest expense figure on the income statement is reasonable, that won't necessarily point to a going concern issue. But I hope you see why letter A would, because if the company's not in compliance with the debt covenant, the bank can force them to repay the entire loan, even if the client's current with the payments. So you know the exam likes this one. Review compliance with debt agreements with regard to going concern issues. Now, we said that there's no specific audit procedures designed just to detect going concern problems, but if problems are found while doing routine audit procedures, and these problems raise the possibility that substantial doubt does exist about the company remaining a going concern, then the CPA asks management to show its plans for continued existence. And such plans usually involve increasing cash inflows, like bringing in additional debt or equity financing, so we can bring in some extra cash right away, or reduce cash outflows, reduce spending now. The auditor would want to see that the company is doing one or the other, either bringing in some cash or postponing expenditures. Which of the following conditions or events will cause an auditor to have substantial doubt about an entity's ability to continue as a going concern? One says significant related party transactions, and it wouldn't be number one, because many companies will purchase their supplier so that they could guarantee an uninterrupted flow of resources, raw materials, and then proceed to make every purchase from that related party. That doesn't point to a going concern problem. Two, usual trade credit from suppliers is denied. Oh yeah, that would be a problem. So if you're normally allowed to pay within 30 days, and all of a sudden the supplier cuts you off and says, now you got to pay on the day you place the order, that points to a going concern problem, because what if you don't have the cash on that day? Then you can't place an order. So 1 is out, but 2 looks great. How about 3? Arrearages in preferred stock dividends are paid. Well, that means you've caught up the preferred stockholders who had dividends in arrears from unpaid years. Well, that's a sign of financial strength, not weakness. If you're able to pay on dividends in arrears, that's not going to point to any going concern issues. So let's go with 2 only here, letter B. How about this one? Davis, CPA, believes that there is substantial doubt about Hall Company's ability to continue as a going concern. In evaluating Hall's plans for dealing with the adverse effects of future conditions and events, Davis most likely would consider as a mitigating factor Hall's plans to what? And if you think you know, leave me the answer in the comments section. And don't forget to like and subscribe, because it helps the channel out a lot. And if you need more help with going concern or any part of the CPA audit exam, go to cpaexamtutoring.com. Get yourself on I-75, where the right teacher makes all the difference.